We have said many times on this channel that one of the best tools that any investor can have in their toolbox is being able to compute the intrinsic value of a company. As Warren Buffett said, price is what you pay, but value is what you get. We want to make sure that we are buying companies that are quality companies, but that we're also getting them at a great price. So the man that you're looking at on the left here is Benjamin Graham. Benjamin Graham was actually the mentor of Warren Buffett, and I think Warren Buffett needs no introduction, one of the greatest investors of all time. But he learned a lot of what he learned from Benjamin Graham. Now, Benjamin Graham wrote a book called The Intelligent Investor. It came out in 1949, and it's basically the start of value investing. Value investing is basically what we do on this channel here with some modifications for modern times. And so in this book, he actually introduced a formula for computing the intrinsic value of a company. In this video, what we are going to do is build out a spreadsheet that computes the intrinsic value according to Benjamin Graham. We're going to look at the formula, we're going to modify it just a little bit, and we're going to see how we can use it for interflame finance investing. So Warren Buffett said it best, price is what you pay, value is what you get. We want to make sure that we're buying quality companies at great prices. So let's go ahead and build out this spreadsheet. So we need to pick a company. For this video, we're going to look at AMD stock. Now we need to look up AMD's earnings per share, their trailing 12 months earnings per share. So I'm going to go to stockanalysis.com. I'm going to look at AMD, and I'm going to look at the statistics tab, and I'm going to scroll down to the middle here, and we can see AMD's current trailing 12 months earnings per share. It is $2.65. So I'm going to go back to my spreadsheet, and I'm going to put $2.65. Okay. Now we need to compute G. G is actually not something that we can compute. G is just an estimate. G is the expected annual growth rate of that company in the next 5 to 7 to 10 years. Now that's predicting out into the future. That's very difficult to do. And so we need to estimate it somehow. Fortunately, stockanalysis.com also on that stats page has, just to the right here, expected earnings per share growth forecast for the next 5 years. So what this is saying is that every single year for the next 5 years, AMD is expected to grow their earnings 55.93%. Now that is very, very lofty. That is very high. We probably don't want to use that number, even in the most optimistic of cases. If we look at their revenue growth, we see the revenue growth is about 31.5%, a little bit more moderate. So if we don't want to use 55.93%, maybe we want to use something around, let's say 45%. So I'm going to come back to the spreadsheet here, and I'm going to put 45% in for G. And I want to look at their current stock price. I want to look at what are they trading for currently, because again, price is what we pay, but value is what we're going to get. I'm going to say equals Google Finance. I'm going to open parentheses, and I'm going to click on AMD to let the spreadsheet and Google Finance know that it's AMD's current price I want to look up. And so what's nice is the default metric for Google Finance is the stock price. And so if I hit enter, we see that AMD at the time of making this video is $202.07. So according to these numbers, what is the Graham valuation? What is the intrinsic value of this company according to Graham? Well, we're going to say equals. We're going to click on the earnings per share, not EPS, but we're going to click on the number that represents the EPS, 265, times, I'm going to click an open parentheses. I'm going to put in 8.5. Now what 8.5 represents is Graham thought that that was the PE ratio of a company that's no longer growing. It's just sort of flat and it's doing its thing. And so that is a no growth company, 8.5. To that, we will add 2 times this growth. Now, the thing about this formula is I'm not going to put in 45% because that's going to be a 0.45. I want to make sure that I multiply that by 100 to make sure I'm not using 0.45. I'm using 45 to represent 45%. I'm going to hit close parentheses and I'm going to hit enter. And we will see that according to the Graham valuation model, AMD stock should be trading for about $261.03. Now that sounds fantastic. Let's compute the margin of safety. And what that means is if Graham predicts that this company should be trading for 261 and the price is 202, well, if Graham is wrong, we want to make sure we bake in a margin of safety that even if we're wrong and it trades for 260 or 250 or even 240, how much can we be off? By what percentage can we be off and still make money? And so to compute the margin of safety, I'm going to say equals, open parentheses, I'm going to click on the Graham valuation value. I'm going to subtract the current price. I'm going to close parentheses, and I'm going to divide it by the Graham valuation. So I'll click on the cell that says 261.03, and I will hit enter. That is a percentage, so I'm going to make that cell 22.59%. Maybe I'll knock off a decimal place and just call it 22.6%. So on Interflame Finance, we actually like companies when they trade at a margin of safety 20% or greater. That's something very attractive to us, something that we might consider buying. So before we continue with a modification to make this a little bit more safe, a little bit more conservative, if you're getting anything out of this video so far, please make sure to like this video. That really helps out the channel. And please consider subscribing so you can keep coming back for more Interflame Finance scoring methodology and intrinsic value of stocks. Now, this formula actually gives us a pretty high intrinsic value for this company. Now, the reason why is because we're using 8.5 for the PE ratio of a no growth company. And there's been modifications throughout the years. Some people use 7, some people use 8. So what we're going to do is we're not going to make that 8.5. We're actually going to make that 7.5. And to make it even more conservative, we're not going to call it twice the growth. We're just going to do 1 times the growth. Okay. So what we'll see is that's actually going to bring down the Graham valuation, the intrinsic value of AMD, quite a bit. So let's go ahead and make that modification. So I'm going to click on my formula. Instead of 8.5, we're going to make that 7.5. And instead of multiplying the growth by 2, I'm just going to multiply the growth by 1. So I'm just going to keep it 45% and then times 100 to make it 45. Okay, so now the new Graham valuation model is the current trailing 12 months earnings per share times the quantity 7.5 plus the growth rate. I'm going to hit enter, and we see that that actually brings down the Graham valuation of this company quite a bit. So that was actually quite the dramatic swing in price, right? We had a 22% margin of safety. All of a sudden, now we're paying a 45% premium for AMD stock just by changing a couple numbers. So maybe if AMD is worth buying, maybe their earnings per share growth is something closer to 55.93%. So let's not go hog wild, but maybe they can actually get 5 years of EPS growth of 50%. So if we change this to 50% growth every single year for the next 5 years, we're still paying about a 33% premium for AMD stock. So I won't show you how I do this, but maybe you want to make this spreadsheet a little bit more appealing to the eye. So I'm going to go ahead and put some colors and some tables and some borders and stuff and make this look a little bit nicer. So if we incorporate the Graham valuation model with the other intrinsic value calculators that we've built out on this channel, which by the way, if you want to check those out, there are links in the description below to see how to make the PE ratios model, the dividend discount model, the discounted cash flow model, and now the Graham valuation model is what we're currently watching. Now, AMD does not pay a dividend, so we're not going to look at the dividend discount model. But what we will look at is the PE ratios model and the discounted cash flow model. Those are quite bullish. AMD is currently trading for 202. These are in the 5 and even the 700s for AMD. Graham valuation, a lot more bearish, a lot more below the intrinsic value, or rather below the current stock price of 202. We never look at these in isolation. We want to use a combination of these. And so we would go ahead and say that the intrinsic value of AMD, based on our calculations and our estimated growth of 50% every single year for the next 5 years, AMD stock is currently worth $486. That is the average of these 3 models. The current stock price is 202. So that gives us a margin of safety of 58.4% for AMD stock. Now, if we were to use a more moderate annual growth of about 40% a year for the next 5 years, then that actually brings the Graham valuation estimate down to about 126. That's paying a 61% premium on AMD stock. So that brings the intrinsic value down to 309. The current price is 202. We're still getting a 35% margin of safety for this company. So from what we can tell at the recording of this video, if we were to get a 40% growth in AMD every year for the next 5 years, we're actually getting a pretty decent bargain for this company at a price of 202. And finally, if we compute everything with a 30% growth rate, well, that actually changes things quite a bit once again. Current stock price is 202. This would be about a $99 company according to Graham. And according to our other models, it's trading closer to fair value, $200 based on the PE ratios model and $280 based on the discounted cash flow. We average those 3 together, we get $193 per share, currently trading for 202. So it's a little overvalued in that case. So we can really see just how sensitive these models are to the growth rate. Whether we're going from 30 to 50%, it's either basically trading for fair value or the steal deal of the century. So it's why really paying attention to the growth rate and making sure you're making educated guesses is going to make all the difference. So there you have it, folks. That is the Graham valuation model. This is a more conservative model than his original model that came out, mainly because we're using 7.5 for flat PE ratios rather than 8.5. and we're not doubling the growth, we're just using the actual growth itself in the formula. And that's just typical of what people do these days to bake in a little bit more caution and a little bit more conservative estimates for these companies. So again, if you got anything out of this video, please like it. That really helps out the channel. Please tell your friends, tell your family, tell your mother-in-law about Interflame Finance. Send them this video so they can accurately predict the values of stocks that they're looking at so that they are not overpaying or even paying fair value for companies. We appreciate you being here, and we'll see you in the next video.